everyone, and welcome back to Crypto Girls. It's me, Sophie, and I'm with my lovely co-host, Nikita. We are going to talk about some really interesting things today, but before we get onto that, I just wanted to give you guys a little bit of an update of some new, very exciting news that we're having in Crypto Girls at the moment. So one of our community members is very kindly and very skillfully crafting a newsletter which comes out each fortnight. And this newsletter will keep you up to date with everything that's happening in crypto and things that are happening specifically on Crypto Girls, i.e. podcast, articles, Instagram posts, everything that's going on in our space. So if you'd like to sign up to that, we have a website, cryptogirlshq.com, which you can sign up to the newsletter for. Today, we're here to talk about a sad event, but it's exciting to us. I feel like this is the way I introduced like every single episode because we've been talking about so many sad things and collapses and whatnot. But today we're talking about Silicon Valley Bank.
Mm-hmm. So it collapsed on March 10, so 11 days ago. And honestly, I've been a little MIA, but it's pretty related to crypto because all the SHIT that happened last year is just kind of all catching up to us. And it's not just like crypto people being weird. It's also like the interest rates. We can also put some blame on Putin for starting a bloody war. And
100%.
like, it's just whenever there's a financial disaster, it's not one cause, it's multiple. It's a cocktail.
Absolutely. And it's, you're right. We've seen so much of this in the crypto space last year, but now with inflation and the war in Ukraine and all these other factors that have contributed to the wider economic circumstance, it's quite interesting to see now traditional finance also being quite negatively affected by the like macro economy, I suppose. I saw this great meme on a Instagram page called Liquidity. If you haven't like seen it, you just got to look it up. It's great if you're into like financial kind of memes. And there was this one, it was like all these finance bros walking around and being like, oh, it was so funny when this big collapses all happened to the NFT guys, but now it's happening to us. Like, this sucks.
Yeah.
And I was like, wow, that's very poignant.
Yeah. At Liquidity, like, I'm giving them free advertising right here. It's a great meme page. Love them.
Yeah, we love them. And they hit on all levels, and they're always like, if you want to keep updated on financial news, but you don't want all the jargon and like boring, like it's kind of like the TLDR, but like memeified. So
yeah, if you're getting like news, but like kind of funny, it kind of just makes you laugh when it's not not a laughing situation.
Yeah, 100%. But anyway, enough of the free advertising of other crypto influencers. I don't know. Yeah. Anyway, so back to Silicon Valley Bank. So as we know, it collapsed, as Nikita said, around a week ago. And it is quite a significant event because this bank was the 16th largest bank in the United States, and the collapse was the second largest US bank collapse in history ever. The biggest one to happen was during the GFC in 2008 when Washington Mutual collapsed. So quite a big deal for traditional finance, but there's a lot of kind of good news, I suppose, for depositors in the bank, but I think we should probably backtrack and talk about what kind of bank Silicon Valley Bank was, who its clients were, and just kind of what the implications of that client base is.
So Silicon Valley was served the Valley, the Silicon Valley, duh. And they served a lot of startups, and to name a few, like Roblox, Pinterest, Roku. What's Roku? I think it's a TV program, right? Or something.
Oh, I don't know, but it sounds spicy.
Yeah.
I know that they did Airbnb and Fitbit as well. So some quite big clients like that. And then I think a lot of venture capital firms, which are not necessarily household names, but there's a lot of money flying in and out of venture capital firms.
Yeah. And all the companies that venture capital firms, I think venture capitals are kind of like almost a one-stop shop where you're a startup, you go to the venture capital firm, and then they kind of give you their contacts, like what bank to use, what, I don't know, marketing person to use. So when venture capital firms are using a certain bank, it's also like, okay, so they have like all these startups affiliated with them. And so Silicon Valley Bank was apparently serving like over 65 or 70% of startups in the US. So like a big deal.
Wow, that is a lot. And I think they also serviced kind of overseas startups or like tech companies. Like I know if you're a New Zealander, you'll probably know Rocket Lab, Peter Beck's company. They had about 30 mil, I think, that they had deposited with Silicon Valley Bank. So yeah, a global reach, obviously. If the 16th largest bank in the United States certainly would have a global reach. And I think it's really interesting to note, I mean, we've talked about the clientele, which has been very heavily based in the tech sector and the venture capital sector and the startup sector. And I think something to note with these kind of clients is that they are companies where the money moves really, really quickly. You know, they're depositing and withdrawing money all the time. And when markets start to kind of slow down and money is not really going around as easily, those are kind of the companies that seem to have, firstly, kind of like the initial pressure kind of falls back on these firms, I feel like quite heavily, but also they're the kind of first to kind of topple, I suppose, in those. And when markets start to slow down, long story short, Silicon Valley Bank lost about 80% of its value, like 80% of its deposits, and they lost 60% of that in one day, which is pretty colossal. Like it was a pretty rapid collapse.
It was it was a total bank run. So people were just taking out all their money because as soon as someone has a little thing of fear, it's called a contagion, really. It's like a virus. It just everyone just catches it and they catch fear. And yeah, I mean, honestly, if someone was like, oh, ASB, I bank with ASB. Not that anyone wants to know that, but like, like if someone was like, oh my God, ASB is going to collapse, I would take my money out. I would be so scared. So, yeah, I get it. But at the same
100%.
time, like, it is that fear that causes the bank to collapse. So it's kind
100%.
of a real tricky situation.
100%. And there is a silver lining in the Silicon Valley Bank situation for depositors. The US has a system that New Zealand has not yet implemented into its own legislation, but I can imagine that legislation will be coming very soon. Well, I hope it will anyway. They've got something running through Parliament, but the US has something called the FDIC, which stands for the Federal Deposit Insurance Corporation. And basically what this corporation does is that it guarantees customers' deposits in banks. So if something like Silicon Valley Bank happens where the bank collapses, each depositor is guaranteed up to $250,000 of their income from the government, so they don't lose that, I suppose, level of their deposit. Of course, a lot of Silicon Valley Bank's customers will have had more than that deposited in the bank. So, I mean, for your like mother and father kind of family depositors, it's great news. But for big corps, maybe not so much. But I suppose that is the silver lining, and I think we kind of touched on this earlier, but maybe we should elaborate on how it kind of went wrong. Like what were the surrounding factors that caused Silicon Valley Bank to crumble so quickly?
So it was a really unique situation where when there was a crypto tech bull market in the start of 2020, 2021, which we might remember when everyone went into COVID lockdown, we were all on Netflix, we were all on TikTok, like everything. Zoom was kind of like went crazy. Upwork, like all these amazing tech startups. They just got an influx of money, and by proxy, the banks also got a lot of like deposits. So these tech companies would store all their like kind of profits or their spare money in the bank and just kind of keep it there like we normally would, and earn a little bit of interest on their deposits.
And Silicon Valley Bank will probably be disproportionately positively affected by a big tech boom because of their client base, just to add that, but continue on.
Well, absolutely. So what a bank does with deposits is they usually put it into an investment, or they loan it out so that they can kind of get some interest or profit off the deposit, and then give some of those profits back to the depositor, and also keep some profits to themselves. But at the time, Silicon Valley Bank was struggling to loan out the money. Like there wasn't enough loan demand. And so what they did is they invested not all, but most of the deposits into treasury bonds, which are usually a very, very safe investment, but they are long-term investments. So they're kind of locked in. You can't divest. You can't just take it out all of a sudden. They're locked in, and you earn like a really small return on like treasury or government bonds usually.
Yeah, 100%. And I think, good thing to note is that, yes, a lot of the things, bonds that the Silicon Valley Bank were invested in were long-term mortgage-backed securities. And those aren't as liquid as a US Treasury bill or like another kind of government bond, because they do have that kind of longer-term maturity date. And I suppose you can sell out of bonds before their maturity date is reached, but a good thing to note, and this is in consideration of the wider economic environment, is that what have we had happen really recently? We've had a lot of inflation, and to combat that, the central banks have risen the interest rates to try and slow down people's spending by increasing the rate it costs to borrow money. And the reason that this has a relationship with bonds is that interest rates and bonds have an inverse relationship. So as interest rates rise, the price of bonds will fall. So Silicon Valley Bank was very heavily exposed to the bond market. It held a lot of bond assets. And so in 2021, the interest rates on bonds were a lot lower than they are today. So people who are buying bonds today are getting more interest by the time those bonds mature than they once were. So that's driven down the price of bonds that were bought in 2021. And this is fine if you hold on to these bonds, because no loss is a realized loss until you sell out. And so Silicon Valley Bank was just kind of treading along and surviving. But as inflation's gotten so intense and more pressure has been put on their client base, particularly tech companies, venture capital companies, and startups, more and more companies have started to kind of cash out. And Silicon Valley Bank, I don't remember which date that this was on, but basically made an announcement and said that it had to liquidate a lot of its bonds, i.e. sell off a lot of its bonds. And as we know, because the bond prices fell, they had to do that for quite a significant loss. And this kind of sparked a bit of contagion, which is something that Nikita was talking before, a bit of fear. And the fear kind of caught on, and more companies started to flood the bank and withdraw their deposits. And this is known as a run on the banks, which is a big catchword that's probably been thrown around in the media a lot in the last week or so. So that's basically the long and short of like how Silicon Valley Bank collapsed.
And I think the timing was also really poorly done as well, because just the day before, so I think it was March 8th, that a bank called Silvergate, another relatively small bank, announced that they were going to liquidate. And I think the causes were very much similar, where like the interest rates had increased so rapidly, and they couldn't keep up with, this these crazy returns. Like if you deposit your money in the bank now, you're going to get like a pretty nice return.
Mhm.
So they just couldn't really keep up with, this sudden change, I guess, we should say. And so, yeah, Silvergate announced they were going to liquidate on March 8th. Then March 9, Silicon Valley said they were going to do like a capital raise and like try to raise some money, sell off some stocks. Then suddenly, like the Silicon Valley was just went crazy. Like founders and stuff started talking. The CEO of Silicon Valley Bank held a conference call and tried to soothe a lot of the venture capitalists. But that did not work. And on March 10, the stock price of Silicon Valley Bank went like this, and then everyone started taking out their assets, and that was like, the bank run. Then after that, there was another bank who got affected. I think it was Signature Bank in New York, similar story. And so a lot of these community banks are now being affected because I guess they all had the similar pressures as Silicon Valley Bank.
Yeah, absolutely. And I mean, our listeners will probably know and have heard of a lot of banks sending out emails and statements saying we're protected from this kind of risk, like, and a lot of governments have been announcing that they will protect depositors or they won't protect depositors. There's been a lot of media buzz around this, as you would expect. And something that happened actually today, 21st of March, was I woke up to a news story about Credit Suisse nearly collapsing because they were, I assume they were very overexposed to bonds as well. They are one of the biggest banks in the world, which was, when I woke up, it was, quite a cortisol boost early in the morning. But fortunately, they have been bailed out by UBS, which is another bank, I believe.
Another Swiss bank. They're like Credit Suisse and UBS are the biggest banks in Switzerland. And for anyone who's unfamiliar with finance, Switzerland is kind of like they're like the masters of finance almost. Like Switzerland and finance almost has like the same ring to it.
100%.
Yeah, they have their watches and then they have their banks. So UBS and Credit Suisse are like the big bros, and I can't believe that Credit Suisse had a bailout. Like it's crazy. Like it was there,
That's
it was
wild.
huge. And then it's gone. And then the Swiss finance minister, I read, she said it's not a bailout, but UBS got Credit Suisse for $3 billion.
That's so cheap.
It's like it's insane.
I'm pretty sure like the assets under management for Credit Suisse, to give this a little bit of context, assets under management for Credit Suisse were $1.4 trillion. $1.4 trillion. Yes. I'm not sure which currency that is, but like $1 trillion in any currency, apart from maybe if you're from Zimbabwe or Venezuela, is like a lot of money.
I think that's like, what's the GDP of New Zealand? I think it's less than that. I think it's less than $1 trillion.
Oh my God. Yeah. Shit. Yeah. I reckon it would only be around like 9 or 10 billion. Maybe that's even, God, the numbers are just that big.
250 billion.
Oh,
so like
9 billion?
No, 250 billion.
I know, but like I just said 9 billion.
Yeah, I think honestly, but I don't blame you because once things get over a certain number, you just can't even imagine it.
100%. Like it's unfathomable amounts of money. But what's really like scary to me, just as a side note, is that like if Credit Suisse has been acquired by another big Swiss bank, like how shit is that for market competition? That's just going to bite depositors and like the UBS customers and former Credit Suisse customers in the arse. Like it's going to be so much more expensive to bank now. So at the end of the day, even though the banks are potentially engaging in risky investments and not having a diverse enough client base and causing all these big collapses, they are continuing to get away with it. And in some cases, i.e. in UBS's case, end up far better off because of other bankers' faux pas. And I am seriously, it's not good for the little man.
No, it's not good. And community banks are really essential. Actually, kind of another cause of these community bank failures is due to the 2008 financial crisis and the subsequent regulations that were put in place after 2008. So for any like Gen Zers who are listening to this, the 2008 financial crisis was huge, like enormous, had impacts all over the world. Afterwards, Obama put in some financial regulations to make banks behave better, and they were really strict. But they were almost too strict for the smaller banks because to comply with the regulations, smaller banks were like, we can't afford this. This is just like too much red tape. And so Trump reversed some of the regulations for community banks. But arguably it's those reversals that Trump made that have made kind of community banks more vulnerable to market shocks or rising interest rates and things like that. So the larger banks are like pretty okay at the moment because they've had all these stringent regulations still adhere to them. But yeah, the smaller banks are really in for some trouble, and we do need them. Like local businesses, local towns need these banks.
Absolutely. And I think, yeah, and in any market, the more competition that is around, usually the better. If businesses are competing with one another, it usually means that the consumer ends up better off. It's just, again, basic supply and demand laws. So it is really sad to see these community banks really feel the pressure. I think one more thing that we should probably chat about in this short, snappy little episode is the USDC depeg, which was, again, quite frightening and probably for a lot of crypto investors quite almost reminiscent of it was nearly very reminiscent of the Terra Luna crash. It has now recovered from its depeg, but to backtrack, USDC is a Circle issued stable coin, which means, and its peg is to the US dollar, and upon the collapse of SVB, it lost its peg and dropped to about 86 cents on the 86 cents on the dollar. 86 cents on the dollar. My goodness. And to be honest, I actually think Circle handles like the PR of this quite well. Like it issued this statement on its website, basically just guaranteeing to USDC investors that USDC was 100% collateralized. The reason that there was so much fear around the USDC stablecoin was because 3.3 billion out of 40 billion of USDC's collateral was invested with Silicon Valley Bank. So that's a decent proportion of their money just kind of up in smoke. But yes, as I say, Circle released a press release on their website guaranteeing that, I say in quote marks, you never quite know with these crypto firms, but saying that it was 100% collateralized in either US cash or treasury bills, which they said were the most liquid asset in the world. Which is true, but we all know from the SVB collapse that bonds can be very liquid. However, they can fall in price because of interest rates. So we'll see what happens with USDC. But at the moment, it's regained its peg. All seems to be well at the moment.
Yeah, at the moment. It's been hectic. Yeah. I also feel sorry for some crypto businesses. I think that Silicon Valley customers and Signature Bank customers, or Silvergate, whatever, a couple of banks are going to be fully compensated. I mean, the customers will be fully compensated because the US government had this insurance fund that I think it actually was instated after 2008, where there was such a massive crisis that they made an insurance fund for future crises. And so depositors with Silicon Valley Bank will, I think, be getting 100% of their money back, which is quite good. But of course, this contagion has spread to other parts of the world. It's spread to the UK. It's spread obviously to Switzerland with Credit Suisse. It's spread to even Japan, where I am right now. So there will be a few, I don't know, earthquakes around the world.
Yeah, 100%. Like, you're absolutely right. I think it's very naive if someone doesn't really expect to see any aftershocks from something like this. And sometimes it's not really even, I mean, banks can be fine, and then people start to get fearful and withdraw money, and then things can topple very quickly. Because if you have enough people going to the banks and withdrawing money, then they are put in a very kind of tight corner where they have to sell out of their investments that they may have projected for wanting to get out of in 10 years, not right now. So I suppose it really just depends on how much fear there is kind of circulating. So we shall see.
Yeah.
If Credit Suisse is struggling, I can imagine that there's probably a lot of pressure on, yes, smaller banks as well.
There was a news article just released a few hours ago about how economists have analyzed that about 190 community banks are going to be affected by this. Let's hope that nothing comes to fruition. I think we're all over it. I remember in 2016, I was like begging for some drama. No, it was 2015. I was like begging for some world drama because at the time, world was so peaceful.
Oh God.
And I was a little bored.
Those were the days. Yeah.
And now I got my drama and I'm over it.
Oh, 100%.
I think that sums up honestly what's happened, like with the whole banking thing. We wrote a blog on it. So if you just wanted to kind of reiterate some of these ideas, there's a blog on our website, just a post called "We Love a Bank Run."
In
No,
quotation marks.
We don't. We know we don't love
like,
a bank
we
run.
love a bank run.
Loves a bank run.
Loves a bank run. Yeah.
No, we don't.
You know, colloquially. Actually, I don't know. That's not even colloquial. I don't know what I'm saying.
It's just like a tired, like, loves a bank run kind of vibe. I don't know if anyone will like get that.
No, I think they will. Like, you know, any girlies that have been on TikTok surely will be all over that sentiment. But yeah, so that'll be up. I think that is already up at cryptogirlshq.com. Yeah, and then our newsletter, which I like mentioned at the start of the pod.
Yeah,
fucking slaps. Thanks, Olivia. Shout out.
All
right. So enough for today. Check out our newsletter. Check out our Silicon Valley Bank article on our website. And we hope you enjoyed listening. As always, any questions, queries, critiques, anything like that, just hit us up. We're always happy to talk. And if you have anything to teach us, we love that too. So we'll see you next time.
See you.
Ciao. Peace out, motherfuckers.